What's going on, everyone? Welcome back to Courtside Financial, where we try to simplify finance for a younger generation. If you're new to the channel, make sure you hit that subscribe button so you don't miss out on any videos that are coming. Are you new to the stock market? Do you also want to invest but take a conservative approach while mitigating risk? Then this video is for you. Today we're going to talk about a strategy that Warren Buffett recommends for most people: dollar cost averaging. Dollar cost averaging is consistently putting money into a single stock or into an ETF, which is a basket of stocks. ETFs are great because they help you diversify your portfolio, and that's one way that you can mitigate risk. Let's say something goes wrong in a single stock. Then you have to stick with it through the lows and hope that the stock recovers. Now, when you have an ETF, what that is a whole bunch of stocks in a basket, which diversifies your portfolio. So if something goes wrong with one stock, then you have a whole bunch of other stocks that you can rely on. The power of dollar cost averaging is because since you're regularly contributing, that means that you're going to be buying the highs, and when you buy the highs, you're buying less shares. When you buy the lows, you're buying more shares. These things are ultimately going to help you get a better average cost by lowering your average cost over time. Have you ever heard the saying, time in the market beats timing the market? For most people, this is really true. A lot of people don't know how to look at valuations and assess a stock, and this is the safest way to go about it without doing too much extra work on the sides, like spending hours on research, which I personally do because I pick individual stocks and I try to beat the market. Historically, the stock market has always made new highs. So dollar cost averaging, even when you are buying shares at their highest price, like I said, you're buying less, and when you buy shares at their lowest price, you're buying more. So all those shares should increase in value over time. So for most people, Warren Buffett recommends dollar cost averaging the S&P 500, which is an index of America's 500 best businesses. Now, if you're going to be dollar cost averaging the S&P 500, what you're going to want is an ETF that mirrors that index. One that I personally look at is VOO, a Vanguard index fund with low fees, which you can get everything that you need out of the S&P 500 through it. Historically, the S&P 500 has always returned 6 to 7% per year on average. Einstein says compound interest is the eighth wonder of the world. So if you're compounding your money at 6 to 7% per year, over the long run, you should be able to have a ton of money depending on how much you're investing. So let's look at this dollar cost averaging calculator of the S&P 500, and let's see how much money you would have made if you dollar cost average with $200 monthly from the year 1990 to now. So if you dollar cost average the S&P 500 from the year 1990, putting $200 in every month, right now in the year 2020, you would have $266,501.71 only from contributing $200 every month. So that's the power of dollar cost averaging. I hope you guys found this video helpful. If you guys want me to do more stock market for beginner videos, then smash the like button, hit the subscribe button, and let me know in the comments. Thank you very much.